Welcome to the deep dive. We're here to cut through the noise and get to the core intelligence. And today, we're tackling something huge. The next wave of institutional money coming into crypto. It's a really big shift. And if you think that story ends with Bitcoin, well, we've got some data that might just change your mind. Our goal today is to really unpack these predictions. The one saying altcoin ETFs are basically inevitable. The next logical step after Bitcoin and Ether found their footing.
Exactly. It's about following the money, but also understanding why it's moving now.
So let's kick off with that Q3 2025 data point. Because honestly, it stopped me in my tracks. Everyone figured Bitcoin ETFs would keep leading the charge, right?
That was the assumption.
Well, in Q3, spot Ether ETFs pulled in a massive $9.6 billion. And get this, that actually beat the spot Bitcoin ETF inflows, which were $8.7 billion.
Wow. Yeah, that's significant. It's not just a small blip. What that really shows is, well, it confirms institutions are getting more comfortable, more sophisticated in this space. Bitcoin ETFs kind of opened the main gate, you could say. But seeing that much flow into Ether suggests the demand for alternative crypto exposure is really heating up.
Alternative exposure, meaning beyond the big two.
Precisely. It looks like these big funds have worked through their internal checks, their compliance stuff, and now they're actively looking to diversify within crypto itself. And regulatory approval is key here. It does two things. One, it obviously makes the asset seem more legitimate.
Right, the stamp of approval.
But maybe more importantly for these institutions, it creates the actual regulated product, the plumbing they need to legally invest. That move from BTC to ETH suggests the plumbing works. And now they're eyeing the whole network.
Okay, so that brings us to this core idea from analysts like Leon Waidman at OnChain that altcoin ETFs are this inevitable next step. But break that down for us. Why does a regulator saying, okay, suddenly translate into billions flooding in? It seems almost too simple.
It boils down to risk and access. Think of the whole regulatory setup, like building highways for this institutional traffic.
Okay, I like that. Highways.
When the SEC greenlit the Bitcoin and Ether ETFs, they essentially built the main interstate.
Yeah.
Let's call it Crypto 95. It's big, it's regulated, it feels safe for the massive trucks, the big institutions to drive on.
Right, handles the main traffic flow.
Exactly. But investors, especially sophisticated ones, don't just want to stay on the interstate. They need specific destinations. They need those exits and feeder roads.
So the altcoin ETFs are those exits.
That's the idea. They're like the regulated, secure exit ramps and local roads that let investors safely access specific industrial parks, maybe a DeFi protocol or an Oracle network or something else specific.
And crucially, they do it without the headaches of managing private keys or custody themselves.
Precisely. They're just buying a ticker symbol, the standard security. That simplification. That's what unlocks the potential for billions. It fits their existing operational models.
And we're already seeing the groundwork being laid, aren't we? Even with things like U.S. government shutdowns potentially causing delays.
Yeah, the momentum is there.
The SEC still got, at least 5 new altcoin or token ETF filings just in the first half of October.
That's right. It shows the industry is betting on this. They're lining up, getting their products ready because they see which way the regulatory winds are blowing.
So Waidman's point holds. Institutions found Bitcoin through ETFs, got comfortable, moved to Ethereum.
And now they're looking down the road at other established, useful altcoins. Once you're cruising on that main highway, you start looking at the signs for those interesting exits, right?
Okay, so if the institutions are scouting these exits, let's look at where the smart money is placing its bets. That Q3 data, ETH beating BTC inflows, shows the demand is real.
It absolutely is. And we can actually get a glimpse of this using tools like Nansen's platform. They track what wallets identified as smart money sophisticated traders early funds are doing.
So peering into their portfolios?
Kind of, yeah. It shows who's positioning themselves now, anticipating which altcoins might get that regulatory nod or which ones just make sense from an institutional use case perspective.
So what are they holding? What are the signals telling us right now?
Well, based on the latest Nansen data we looked at, 3 names keep popping up at the top of their holdings: Uniswap, UNI, AAVE, and Chainlink, AAVE.
UNI, AAVE, Link. Okay. Why those 3 specifically? It doesn't feel random.
Oh, it's definitely not random. It's calculated. These aren't just meme coins. They represent core infrastructure or services within DeFi that institutions can understand and potentially utilize.
Right. Let's break that down. Uniswap, UNI, that's a decentralized exchange, the biggest one.
Exactly. Institutions need deep liquidity. If a big fund wants to buy or sell a significant position, they need to know they can do it without drastically moving the price against them. that slippage.
Okay.
Uniswap, being the largest DEX by volume, offers that established liquidity pool. It provides a level of market depth and execution reliability that institutions require. It's about trusted execution.
Makes sense. What about EF? That's lending, right? Seems riskier.
Well, yes and no. Aves tackles institutional risk aversion in a really interesting way. Think about traditional finance. They rely heavily on prime brokerage for secure lending and borrowing.
Mm-hmm.
Aave is kind of the DeFi equivalent, but with a twist, institutions might actually prefer mandatory over-collateralization.
Meaning you have to put up more value than you borrow?
Significantly more, yes.
Yeah.
It's built into the code. So the risk is mathematically defined and minimized. For institutions wary of counterparty risk, Aave's model, with its battle-tested code, offers a sort of transparent, automated prime brokerage. They see the collateral, they understand the risk parameters.
Okay, clear risk mitigation. And the third one, Chainlink, Link, that's the Oracle network we hear so much about. Why is that essential?
Chainlink provides trust. If institutions are ever going to build serious financial products, on-chain sync derivatives, insurance, complex trading strategies, they need reliable, tamper-proof data feeds.
Real-world data brought onto the blockchain securely?
It's exactly. Prices, timestamps, event outcomes. Link is the industry standard for providing that secure, decentralized data infrastructure. It's like buying the company that provides the certified scales and measures for the entire crypto economy. It's foundational.
So the path seems clear. Regulation builds the roads. Smart money signals the most promising destinations like UNI, AEE linked based on utility and risk management.
Seems logical, yeah.
But there's always a but, isn't there? We have to talk about the counter-argument, the big potential snag in this altcoin ETF narrative.
Ah, yes. The elephant, or perhaps the whale, not currently in the room.
You mean BlackRock?
Precisely. When you look back at how the Bitcoin ETFs launched and gained traction, BlackRock wasn't just a player. They were arguably the player. Their influence was immense.
You used the metaphor before we started recording the gravity well. Explain that. Why was BlackRock so critical?
Okay, think of it like opening a huge new shopping mall. You need a massive, trusted anchor tenant like a Macy's or Nordstrom in the old days to draw everyone else in.
Right. Gives confidence, attracts other stores and shoppers.
BlackRock was that anchor tenant for Bitcoin ETFs. Their sheer size, their impeccable reputation, their deep ties with the biggest pools of money globally, pensions, sovereign wealth funds. Their entry signaled to everyone else, okay, this is serious, this is safe, this is institutionally acceptable.
They provided the initial critical mass and trust.
Absolutely. Their marketing muscle and implicit endorsement pulled in countless other institutions and smaller funds that might have otherwise stayed on the sidelines.
And the financial impact numbers are, well, they're kind of staggering when you isolate them. What did BlackRock's Bitcoin ETF actually do in 2025?
It's pretty incredible. BlackRock's Bitcoin ETF alone pulled in $28.1 billion in investments just this year so far.
$28 billion. Okay.
But here's the kicker. According to data analysis, like the work Vetalunda did at K33, BlackRock's fund was the only spot Bitcoin ETF to actually have positive net inflows year to date.
Wait, hang on. The only one. So you're telling me that without BlackRock, the entire spot Bitcoin ETF complex would have actually seen money leaving this year?
The data suggests exactly that. If you take BlackRock out of the equation, the remaining spot Bitcoin ETFs collectively saw a net outflow of about $1.27 billion year to date.
That's actually quite shocking. It implies the whole positive narrative, the institutional floodgates opening for Bitcoin this year, was almost entirely down to one single company's product.
It points to a very strong reliance, yes.
All right.
It suggests that initial wave of massive institutional adoption was heavily catalyzed, maybe even carried, by that single trusted anchor tenant.
Which leads to the obvious concern for altcoins. If BlackRock isn't involved in these first filings for UNI, AAV, Link ETFs, what happens? Do we miss that huge initial push?
That's the risk, isn't it? The regulatory highway exits might be built, the vehicles, the ETFs might be available, but if the biggest, most trusted trucking company isn't using those exits yet.
The traffic might be much lighter initially?
Exactly. We might not see that same tailwind effect. The inflows could be much more modest to start. It might be more of a cautious trickle than the floodgates opening wide, at least until BlackRock or a similar giant steps in.
So that really crystallizes the tension here. We've got altcoin ETFs looking like the logical, regulated next step, opening access to high-utility protocols like Uniswap, Aave, Chainlink. But the massive catalyst that arguably drove the Bitcoin ETF success, BlackRock, isn't part of this initial altcoin wave, which puts a question mark over the immediate scale of inflows.
It really does, and it leaves us and you, the listener, with a really interesting question to think about. If institutional adoption hinges so heavily on these specific regulated products backed by giants like BlackRock,
Yeah.
does that mean the future of institutional investment in altcoins will mostly focus only on the tokens that manage to get this top-tier regulatory approval and backing? Could regulatory safety, championed by the biggest players, end up overshadowing actual innovation or utility for the bulk of institutional capital flowing into this space?
That's definitely something to chew on. Does the need for regulated wrappers fundamentally centralize institutional focus in a decentralized world?
A question for the future, perhaps.
Indeed. Well, that's all the time we have for this deep dive. If you found this useful, please do follow, like, and share the show. It really helps. And of course, you can keep up with what Bitcoin taught me pretty much everywhere. Twitter X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks for tuning in.